Welcome back, guys. So in this particular episode, what we'll be discussing about is business combination. Okay, the second part of the question consists of, what does it say is that on 1st Jan 20x4, Bolo acquired 45% of ordinary shares of Kata, right? Consideration was paid 3 million. Carrying amount of the net assets of Kata at the date were 2.4 million and approximately their fair values. The statement of SOFP for Kata at 31st December 20x4 was this much. And then directors of Bolo are unsure whether to treat Kata as an associate or subsidiary in the consolidated financial statement. When relevant, Bolo measures uh, NCI using proportion of net assets method. Okay. So discuss and compare the impact on SOFP of Bolo for the year ended 31st December 20x4 if the investment in Kata is accounted for as an associate and subsidiary. Okay. So first of all, let's find out a few things. Okay, so let's open Sheets, Google Sheets, and then after that what we need to do is that first of all, let's working note number 1, right? So we don't need that as well, we can do directly goodwill calculation, right? Calculation. So cost of investment, fair value of NCI, which is basically that, and then net assets at ACQ. So let's put in the values. Cost of thing is consideration paid was 3 million, right? So on 1st Jan 20x4, we are preparing it for 31st 20x4. Okay, exactly 1 year. So carrying amount of net assets at the date by 2.4. So 3 and 2.4. And then 45, right? 3.4. This is this into 0.45. No, not 45. 45 is our holding. Their holding is this much. So this plus this, and then this minus this, right? So this will be our goodwill. So next thing that we need to calculate is non-controlling interest. Bold it. The value of NCI, share of post-acquisition profit, share of post-acquisition profit will be okay, so it's 15, right? No, 3. 3 minus 2.4. 3 minus 2.4. 3 minus 2.4 into 55%, 0.33. So this will give us a non-controlling interest of this much, right? So if it is classified as subsidiary, then what will happen? Investment in subsidiary will be basically cost and then group share of profit. So cost is 3 million. Group share of profit is 3 minus 2.4 into 45%, right? 0.27. So this will be this plus this figure. Okay, so NCI, this is the same figure. Okay, so subsidiary. Right, so if accounted for subsidiary, if accounted as a subsidiary, the assets, liabilities, income and expenses are consolidated with the parent, right? And then after that, goodwill will be recognized that is, how much was it? 1.92 or dollar 1.92 million. And then what would be recognized as well? NCI as well, right? And then the group would recognize its share of Kata's post-acquisition profit or post-acquisition retained earnings. This would amount to 2.4, right? No. So what was the earlier profit? Before that, so basically it was 3 and then 2.4, right? 3 and 2.4. 2.4. I mean, it should be this way. Okay, right? So what would happen is that basically post-acquisition profit would be 3 minus 2.4. 3 minus 2.4. This minus this. 5%, which will be this into this. 0.27, right? 0.27 million, which is basically 45% of 3 minus 2.4. Right, and then NCI in respect of Kata of dollar 1.65 million would be recognized recognized. This is what would happen, right? So if accounted for associate, if accounted for as an associate, the investment in Kata at the year end would be carried at 3.27 million. 3.27 million and group's share of profit. Share of profit recognized in profit or loss be $0.27 million. Then after that, comparison of impact, right? Where will it hit? First thing will be assets. C. Assets. Second that it will hit is liabilities. Liabilities. And then profit or loss. Gold. Consolidating data would lead to a higher non-current assets than if equity accounted. If in equity method assets worth $3.27 million would be recognized, whereas if it is consolidated, then how much was that? 14 plus 115 plus what was the goodwill? 1.29. What was the other one? Okay, that is inventory. Whereas if consolidated, then it would be reported at $15.92 million. Right, that would be our first impact, and then after that, this will make the group look more asset rich, which may help to finance in future. However, consolidating Kata's balance Kata's large PPE balance may have a detrimental impact on the group's assets turnover ratio, thus making it look less efficient and generating profits. Right. Another thing that will happen is that consolidating the loan of Kata may have a negative impact on the group's gearing ratio. This may have the effect of making the group look riskier than if equity accounting is used, right? A higher gearing ratio may make it harder for the group to raise finance in the future. Consolidating the incomes and expenses of Kata line by line will impact these profit or loss figures such as revenue, gross profit, and profit from operation. Increased revenue and expenses may make the group market share look more impressive. Kata is profitable, so consolidating its results will improve group's profit from operation, which can have positive impact on perception of investors, right? If Kata was accounted for using equity method, the group would simply show its share of profit as a single line below profit from operations. This would therefore have no impact, which could be positive or negative, on the group's operating profit. All right. So this is it, guys. So if you have any confusions until now, so this is the impact, right? Basically. So if you have any confusions or if you want to add anything to this, you are most welcome. I will be looking forward for your comments. And if you have any other suggestions that you would like to make or any questions that you would like to ask, please feel very free to comment down below. I'll be looking forward for your comments. Until next video, bye bye.